All right, so look at this article right here from Simply Wall Street. Are investors undervaluing Ford Motor Company by 31%? Oh Lord, here we go. Here we go. I want you all to look at this article real quick and look at all of the terminology, the words that they use that will get you to think that it's all a guess. All right. So what would make them state that Ford is undervalued by 31%? Well, they go into discount cash flow model. Okay. Here it is. Our analysis will employ the discounted cash flow model. Models like these may appear beyond the comprehension of a layperson, but they're very easy to follow. All right. Now, here's that word. We generally believe. Oh, okay. Nothing is set in stone. Nothing is cemented in fact. It's all a belief. So according to the person who wrote this article, they believe that a company's value is the present value of all of the cash it will generate in the future. Now, last time I checked, I don't think nobody on Wall Street has a crystal ball that can be definitive on how much cash a company is going to bring in the future. Again, that is another crux in this analysis of utilizing the discounted cash flow model. If you cannot at least get in the ballpark, in the range of how much cash a business will generate in the future, your analysis will be shot off rip. Like, you won't even get it correct off of that alone. But they want us to use this DCF model. However, a DCF is just one valuation metric among many, and it is not without flaws. So he or she even goes into telling you that if you're going to use DCF, understand that it has problems, that it's not perfect. The model, they're going to use a two-stage DCF model, not one, but two, adding to the complexity of the model. The first stage is generally a higher growth period, which levels off heading towards the terminal value. To begin with, we have to get estimates. Of course, not factual. It's just a guess. It's an estimate. Now, where do you get that estimate from? Maybe you get it from another Wall Street analyst. Maybe you come up with a number on your own of the next 10 years of cash flows. Now, we're not talking about near term. They're talking about getting cash flows for 10 years out. Seriously. I'm not talking about 10 months. I'm not talking about 10 days. They're getting estimates 10 years out. Let me know, one of you all, what are you going to be doing in 10 years? How much cash are you going to be bringing in 10 years? Exactly. You don't know. But they want to use a DCF model and try to grasp some estimates of where a company can be in 10 years. Now, how do they come up with these estimates? You can only go off of historical information. But we live in a very dynamic world. New technologies are going to come through. Have you heard of AI? Like, AI is going to be impactful for these businesses. You don't think they're going to instill it into their every facet of work and product that they generate and manufacture? Yes. You have EV. You have new battery technology. Like, all of this, you cannot even contemplate how much value those new technologies will bring in for any business, let alone Ford. But they want us to use the model. Now, next thing, we assume companies with shrinking free cash flow will slow their rate of shrinkage, and that companies with growing free cash flow will see their growth rate slow over this period. Okay, so now they're presuming things. We just guess, we just say companies with shrinking free cash flow will slow their rate. Now, what if they don't already? Like I said, the DCF is shot. Generally, we assume that $1 today is more valuable than $1 in the future. Why is that? Because you actually got it in your hand? But what if the monetary system, like inflation, begins to go down? thereby increasing your purchasing power of the dollar in the future. That's why he started the statement or the sentence with generally, because it's not always true. It's not based in fact. Things change. So that also has to be contemplated and thought about when you use DCF. Okay. To get the intrinsic value per share, we divide this by the total number of shares outstanding. Well, what if Ford or another company issues more shares in the next 10 years? Or what if they do a stock buyback, reducing the number of shares outstanding? Like, you cannot actually encompass all of the things that can occur in a business of this size like Ford. You can't, because you don't know what they're going to do in the future. But apparently you got to divide the total number of shares outstanding at the current time, not knowing what's going to happen 5-10 years out. Remember though, that this is just an approximate valuation. And like any complex formula, garbage in, garbage out, boom. I mean, like, so what's the point of us talking about DCF then? If you implement and place the wrong calculations, implement or input the wrong numbers, you're going to get a wrong answer automatically. So why would you try to make people use a quote complex formula when any one mishap would throw your whole calculation off course? But they want you to use it anyway. Okay, got it. Important assumptions. The calculation above is very dependent on two assumptions. The first is the discount rate, and the other is cash flows. You don't have to agree with these inputs. I recommend redoing the calculation yourself and playing with them. Oh, so now we got to play with the numbers. We have to finagle, manipulate the numbers to get it to what we want to see. That's why he or she, whoever wrote this article, is saying that Ford is undervalued by 31%. Because that's what they manipulated the numbers out to be. The DCF also does not consider the possible cyclicality of an industry. Duh, I just told you all that. Especially with new technology and innovation, or a company's future capital requirements. So it does not give a full picture of a company's potential performance. So why are we utilizing DCF then? Why? What's the purpose? While it's important, the DCF calculation shouldn't be the only metric you look at when researching a company. Now, we got to go out, get all of these estimates, finagle the numbers, manipulate the numbers to what we need it to be, guess what's going to be in the next 5-10 years. And then he goes on to say, just don't use DCF calculations. You got to try other things too. The DCF model is not a perfect stock valuation tool. Rather, it should be seen as a guide to what assumptions need to be true for this stock to be under or overvalued. So assumptions need to be true. Now, how many assumptions are we talking about? A whole gambit. A lot of them. Too many to count, because there's things that you have not even thought about that's going to impact the stock price. So if there are so many assumptions that we cannot even list, why are we going to use DCF? For instance, if the terminal value growth rate is adjusted slightly, it can dramatically alter the overall result. Are you serious? It doesn't even have to be off drastically, just a little bit. It can dramatically alter the results. Man, that's why I don't mess around with that, because it's all a guess. And these individuals, these people on Wall Street, get paid money to try to throw this out at the retail investor. They don't even utilize, in my opinion, I don't even think they utilize it like that. But they want us to think that that's something that is very impactful in seeing how a stock is valued. A stock is only valued off of what you and the other person is willing to buy and sell it for, period. That's the value. That's why Ford is currently trading at $12.36, because that was where an equal of minds occurred and said, I will buy Ford stock at $12.36, and someone said, I will sell it to you for that. Boom. That's the value right there. That's the last trade that people value Ford. So they're trying to say in the article, let me see if I can find it real quick. I want to say that they think that is worth $18.33. That's what they think according to the DCF model Ford stock is worth. Okay, cool. If that's what his DCF model is saying, then explain to me, why is it trading at $12.36? Like, make it make sense. It doesn't make sense if you utilize the DCF model, which is why we don't push that. We only push the price chart. Now you guys can see here that I did a price prediction in Ford right here on the 22nd of December, looking for the market to go up from out the gate. Yes, price in Ford went down. It came to our buy zone right here. Okay, so the trend did break, so we could get rid of that. We can lower our support area down there, and we're still looking for the market to go higher in Ford. Target, first one target is already hit. That is 4.95%. Our second target is next in line. Nothing has changed so far. We're still looking for the price in Ford to go higher. Okay, let me see this on the 2-day chart real quick. Here it is on the 3, 5 week. Yeah, I like it on the longer term charts too. Definitely on the long. I like the 3 weekly chart. So yeah, I'm not going to change my price prediction. I'm still looking for the market in Ford to go higher. Plain and simple. I'm not talking about no DCF models or anything of that sort. I'm not assuming anything. We're simply going off of what the market has determined as value off of price action. That's it. So go ahead and give me your thoughts. Make sure you maintain the profitability. And as always, trade different.